All right, welcome back to the LTC Tree video podcast. I'm Drew here, and I'm with my cousin slash business partner, Darrick, over in Atlanta. Hey, Darrick, how's it going?
Hey, good morning, Drew. Happy Thanksgiving. It's fast
Yeah, you
approaching.
too. Yep. I'm up here in South Carolina at Mom's house. Not far from you. Flew right over you. What are we talking about today?
Today, we're going to talk about long-term care insurance and the benefit period. It's also known as a benefit multiplier. What that essentially is if you need long-term care, this is the amount of time that your policy is going to pay benefits if you religiously pulled out the full monthly or daily rate. Why don't you explain the details? If they say they don't pull out all the money per month, the full amount that they have, what happens at the benefit period?
Yeah, so I think there's a lot of confusion. A lot of people think when they hear 4 years and benefit period, they kind of naturally think, oh, that means my coverage lasts for 4 years from today. Like if I buy the policy today, I need to do something in 4 years because my benefit period's over. It's totally opposite of that. Most long-term care policies are guaranteed renewable for life. So when we talk about benefit period, we're talking about the pool of money, the time period that your policy will pay. To answer your question, Darrick, and for a lot of people asking, well, let's say you have a 4-year policy, but you don't use up all your benefits in 4 years. Well, whatever's left in your benefit, your pool of money is still available. So a 4-year plan could last you 8 years. I know you recently had one of your clients that was really digging into the language on that in one of their policies.
Yeah, so I mean, I've had some claims to where I've got a 3-year policy to last 10 years. So that's obviously they had a 5% compounded growth on the benefits. So that actually it really outpaced inflation. So that allowed us to just take a fraction of what she had available per day and needed home health care kind of every other day for a good number of years. But yeah, I mean, so the point being is as long as you have money left in your pool of money, you can use the benefit. I'm going to give you an example, a number example of what a pool of money is. So you had a $150 a day benefit uh, benefit, and it was for 5 years. So to compute your pool of money, it's $150 times 365 days in the year times 5 years. If you work out the math, it's $273,000. So if you religiously pulled out that full 150 every single day in 5 years, you'd exhaust it in exactly 5 years. But most long-term care doesn't work that way. It's home health care every other day, 3, 4 days a week, 5 days a week. So there's a very good chance that at the end of your benefit period, you still got money
Yeah.
left over, and you can use it till it runs out.
Now, I would say there's one exception to that, and that would be the indemnity plans, because as a policyholder, you're really incentivized to pull out your full monthly benefit every month, which you can do. So even if, like in your example, somebody had 3 days a week of long-term care, they can pull out the full monthly benefit, even if that exceeds what their actual costs are if they have an indemnity hybrid plan. And that's a whole nother video that we've probably already made a couple of, we'll make some more of. But
Yeah.
for most people, if you're getting reimbursed for your actual expenses, there will be some months, like you say, where you may not use all of the money in the pool and you're not losing it. It's tacked on to the end of the policy. Let's talk
Yeah.
about short-term care because that's that Aetna recovery care is an up and coming star.
Yeah. So the short-term care plans, I mean, they're really designed to cover like maybe a year, maybe two of coverage, which statistically, especially for men, that's usually how long people need care.
Yeah,
But yeah, it'll give you the Aetna plan. It'll give you 365 days worth of coverage in a facility, and then
360
they give you a
days. Yeah.
separate pool of money for home care.
Yeah. And the reason why we even bring this up is that plan is much more budget friendly. So for a lot of people, if their alternative is doing nothing because the cost of a long-term care plan scares them away, it's a fantastic alternative to consider.
Yeah, yeah. Now let's talk about Drew. When you're selecting a benefit period, what types of things do you think of? Do I do a 3-year, 4-year, 5-year, 6-year, or there's a couple companies that have an unlimited, it'll pay as long as needed. How do I kind of navigate those decisions?
Yeah. So it comes down to, I mean, the counseling that I give a lot of clients is, first of all, you got to consider your budget, but also consider your family history. There's a lot of people come to us, they've seen parents in need of care, and they're aware of how long some of these claims can go. One of our providers that sells the lifetime, so they are a little bit, biased, but they say that 20% of claims exceed 5 years. If we flip that around the other way, and there's lies, damn lies, and statistics. So I don't think the number's quite that high, but there's probably a way to manipulate it. Um, I tend to tell people if you're not really sure where to go, maybe go 3, 4, 5 years, something like that.
Yeah, yeah. I think like as far as pricing, it's all about the benefit to premium ratio.
Yep.
And I've been doing this since late '90s, so I've seen a lot the evolution of the pricing in relation to these to the benefits. And I really think the sweet spot is that 5 year benefit period
Yeah.
as far as benefit you get for the premium dollar put in, because you can compare like getting a 3 year plan versus a 5 year plan. And if you think about statistically going from 3 to 5, that's giving you 66% more coverage to go from 3 to 5, but it's not 66 more
Not even
premium.
close. It's like
It's
20
not,
some odd percent.
like maybe 20%. So I like if you have the money, obviously, because insurance is about um, reducing the catastrophic risk. Having that those extra 2 years, that gives you the freedom to maybe spend the first few years at home without having to have burned through all your coverage. It's very common. People do spend a couple of years at home before they even get to the facility. And if you only have a 3 year plan, you've really burned up most of your benefits by the time you get to the assisted living facility. Now,
Yeah.
once you're there, most people don't last too long, more than 2 3 years in the facility. But always factor in home health care when you're making that decision on the benefit period.
Yeah, that's a great point. And when I think about it, I put my money where my mouth is. So when I bought my mom a long-term care policy about 11 years ago, and I'm here at her house right now, she's doing great 11 years later, but I did a 5 year benefit period. And what I did was I went with a little bit lower monthly benefit amount to cover the cost of those extra years because I'd rather have
Yeah.
that tail risk covered even at a lower monthly amount than have a shorter policy that's, like a little bit higher monthly amount. So, there's all these trade-offs that we can kind of help counsel people through and help them figure out what makes sense for them. But I agree with you, the 5 year is the sweet spot. There's a reason why they call this long term because there are a lot of claims that go past a couple of years when you factor in that home health. Let's talk about the lifetime though, because we just got a pricing update from one of our carriers here in late 2024. And I'm seeing that unlimited benefit period. Yes, it does cost more, but for some people with maybe Alzheimer's in their family, something like that, it may be worth at least investigating. I mean, they should at least have us run one of those quotes.
Yeah, because the unlimited benefit period, that just simply means it's going to pay benefits for as long as it's needed. I'd say, honestly, I just had a thought, but really around the financial crisis back in 2008 when the Fed started dropping rates so low, a lot of these companies started eliminating that unlimited benefit period to where now I think only two that I can think of have it. Um, it could be that maybe you said the pricing, just was updated. Maybe the fact that interest rates are higher, it's making these insurance companies healthier so they can give more benefits. I don't know if that plays into the calculus, but yeah, it's the what State Life One America, is that the unlimited plan you're talking about?
Yeah, yeah. To get specific, yeah, the One America Asset Care. I just ran it for a couple in Washington, and basically their options were we can have $12,000 a month. I'm getting kind of in the numbers here, but sometimes people like the numbers. Mid
Yeah.
60-year-old couple, they could have $12,000 a month combined for the couple for 6 years, or for exactly the same money, they could have $8,600 a month forever. And
Mm.
so, you have to come to think, well, would you rather have more money up front, but only be capped at 6 years for a couple? So that's, 3 and 3 or 5 and 1 or whatever, or just not worry about it whatsoever and take $8,600. I don't know. What's your thought on that one?
I always tell clients that, typically this is just a rule of thumb. Everybody's situations can be a little bit different, but like as a rule, as you age, your bills get paid off. You don't have a mortgage anymore. You don't have car payments. You're not traveling as much, but yet you have this income coming in. So it's a small mistake versus a big mistake. A small mistake is, you know, yeah, maybe I didn't need that fourth and fifth extra year. But a big mistake is what if you do need that? So
Great point.
I would rather have a longer term and a lower monthly benefit versus a higher monthly benefit and a shorter term,
Yeah.
just because. most people, say the risk is, say that the nursing home bill is $8,000 and their policy is only paying $5,000. They could probably come up with the other 3,000 just from Social Security income when they're
Yep,
85 years old. I'd rather go down that path as opposed to having to come up with the full out-of-pocket cost for that fourth and fifth year.
I agree. And the other thing, I know we were kind of like just tossing around ideas before we jumped on the recording here. You mentioned gender differences. Let's talk about that.
Yeah.
Women make longer claims than men. So the averages from the Health and Human Services are 3.6 years for women and it's 2.5 for men. I was going to have you guess, but I mean it's like it's just sad. Men definitely, knock out faster than women. So for a couple, you might want to look at kind of targeting the risk if that makes sense for some couples to keep the budget in order.
Yeah. Now, was that like a stay in a facility? Is that what you're referencing for women?
Yeah, yeah, I think that's in the facility because, like you say, when you
Yeah.
add in the home health care, that changes changes the claims are going to be longer, plain and simple.
Yeah, yeah, and that's the good thing about these long-term care plans is you can use the benefits at home or in a facility, and if you have a going back to what you said earlier, these cash indemnity, a lot of the cash indemnity plans would be hybrid life long-term care plans, which they have benefit periods too. You're paid cash. You can spend the money on whatever you want. You can pay your family member. You could pay your spouse. It's ultimate freedom
It
when you
is
go to spend
awesome
it.
freedom. One other
Yeah.
statistic, pulling up, looking at this Health and Human Services, and then we can wrap this one up. 20, so okay, with women, 64% are going to develop a disability that requires daily help. In other words, they're going to need long-term care. And 26% of women, more than one in four, are going to need care that exceeds 5 years. That's the Health and Human
Mm,
Services statistic.
wow. Yeah,
So
I could see that, and
we can see that in the pricing.
the economist in me is coming out, and I just can't help but to think of the statistic there. That's probably of the average of the general population, right? Not
Yep.
the insured population, right?
Yep. Two different cohorts.
So yeah, so we're not trying to scare you. We want you to get the appropriate amount of coverage for you. So think about it. You have the average insured population. You have people who have had cancer, diabetes, they're severely obese, in a group of people who have good health.
Yeah,
They're
like the
kind of
people that
mixed
are
on
in line of the
together.
DMV is what you're talking about. The people in
Yeah,
line of the
exactly.
DMV, that's the general population. The insured
So
population is different.
yeah, the insured population, the actuaries and underwriters are going to filter you out if you have good health. And so probably of the insured population, it's going to be less.
Yeah,
So
it's
just to
definitely
kind of
gonna be
keep it
less.
real for people.
Yeah,
But
yeah.
still though, but general population, that's a good statistic to, because I don't think we can even get those numbers from
People
what
ask me
the,
all the time about realistic claims data, and it's been a long time since any of the carriers have like given out real detailed claims data because it's
yeah,
proprietary.
yeah. So that's the risk management that they kind of, I don't know. They actually they don't have those. They don't have the tall buildings for no no reason.
Yeah, we
So
always tell people that. Yeah, so to wrap
yeah,
things up, selecting the appropriate benefit period is really it's all about managing risk. And I really like the point you said about big mistakes versus small mistakes. I think that's a good, wise way to look at this.
yeah. So well, great. Well, yeah. Thank you all for looking at this. We do videos like this. Hopefully, it'll be. It's the goal is to a couple a week, sometimes weekly. Um, but yeah, we put all topics: long-term care insurance, annuities, life insurance. So come back to this channel, and we'll be happy to post as many as we can.
All right, we'll wrap it up. Thanks, Derek.
All right. See you, Drew. Bye.
Bye.